Wake up money. What is it and how do you get it? Hi, this is Clint with the Stitser Real Estate Group. And before we begin, I want to call your attention to two links on my blog. First, if you want to buy or invest in real property, click on the Search Now link. If you want to sell real property, click on the Property Valuation link. So let's get right to it. What is wake up money? Well, it's pretty simple. You wake up and you've made some money. More importantly, how do we get it, and does the market in Reno and Sparks currently support it? In thinking about this question, I decided to create a case study on an offer I wrote today for an investor. Today is, let's see here, it's Wednesday, February 10th, 2016. Let's see what the market and what it's offering and how it's performing. So let's go ahead and look at it. Building wake up money. Here's the property made an offer on today, 3035 Santa Ana Drive, basic 3-bed, 2-bath, 2-car garage home, 1,400 square feet. It's in Donner Springs, so very centrally located in town. Let's look at the purchase assumptions. Because of its price point and the condition is very, very nice on the inside, I'm going to assume it's going to sell at full price, $239,900. For an investor, we're going to assume a down payment of 25%. Or $59,975. For simplicity, we'll call it $60,000 with a loan amount of $179,925. Today's rates are about 5%, so we're going to assume an interest rate of 5%. And then we calculated taxes and insurance, talked to an insurance agent, looked at the county website. Monthly tax and insurance about $160. So by the time we take into consideration our taxes and insurance, and our 5% required debt payment on that loan amount of $180,000, our total monthly payment is going to be $1,125.88. Now we know what it costs to purchase it and carry it. Let's look at the rental side of the equation. Based on hotpads.com, again, hotpads.com, we very easily looked at the neighborhood and saw that this style of home in this condition was around $1,350. The maintenance and vacancy factor of 10%, we're going to assume 1 month of vacancy in a year. Rents are very, very strong in Reno right now, so 10% for vacancy and maintenance is pretty fair in today's market. We're going to amortize that over all 12 months and charge $135 a month and just set that aside for when those expenses come. Hopefully they don't, but if they do, we've set it aside. Now, our monthly payments on our mortgage, which we pulled from the last page, is $1,125.88. So what does that leave us with? A net cash flow of $89.12. Now you might be thinking, Clint, yes, we invested 60 grand to make 90 bucks a month. You're the man. Look, I know that that's not super exciting, 90 bucks a month for a $60,000 investment, but the return on investment for real estate is a lot more complex than just our monthly cash flow. So let's look at how all these pieces of the puzzle fit together. First, of course, we're going to look at our cash invested, our down payment of about $60,000. Then we'll look at our cash flow. Now we're looking at an annual basis here. Annual cash flow of $1,068 a month. That's a return on your cash invested of about 1.8%. Then let's look at your equity earned. What do I mean by that? Well, your principal pay down. Your renter is paying your mortgage payment. Inside of your mortgage payment is principal. So in the first year, they paid $2,815 of your loan off. Because the way that loans are amortized, the beginning of your loan payments is a lot more interest and less principal. As you get later in the loan term, they're paying more and more and more of your principal off. So that number, that 4.69%, is only going to accelerate as you hold this property on the long term. Now we're going to look at depreciation tax savings. This is going to be different for everybody, and I strongly advise you speak with your accountant. For illustration purposes, we're going to assume a 30% marginal tax rate using the IRS's 39-year depreciation schedule. That provides a tax savings of $1,845.30. That's another 3% return on the $60,000 of cash invested. Then we're going to look at 3% capital appreciation. What do I mean by that? Well, if we look at property over the long term in the United States, on average, it appreciates at a 3% rate per year. Yes, there's super high ups and some downs, but if we were to draw a line that goes through the average of all that and you hold it on a long-term basis, it's 3%. So we're going to assume 3% appreciation a year. Based on our original purchase price of $239,000 year one, that's $7,000 in increased value. That's a 12% return on your initial investment of $60,000. We add up all of our returns that are calculated on the right-hand side there, and that creates an annual return on the cash invested of 21.5%. So at the end of the day, a 21.5% return on initial cash invested, it's a heck of a lot more exciting than an original $90 a month I talked about earlier. But still, it's worth pointing out that 21.5% is attractive. It's still not for everybody because there's liability involved in servicing debt. You're dealing with people. Maintenance has to occur. It's not like you have to do nothing. There is still required effort, and it's not for everybody. So if you or someone you know is interested in exploring real estate investments, we would love to have a conversation with you and help decide if it's the right fit for you. In the meantime, I hope that you enjoyed this video. If you have any questions or comments, please reach out. Let us know. This is Clint Stitser with the Stitser Real Estate Group wishing you great success in all your real estate ventures.